Hello, my name is Troy Atkins, and I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a housing advisory services company. I want to talk to you today about the key events that have transpired in the U.S. residential housing market during the second quarter of 2021. During the second quarter of this year, a review of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University was the primary topic of discussion. ACM has assessed the JCHS report and organized its findings based on the following general topics: housing policies, housing problems, housing inventory, housing sales, and housing ownership. In addition, ACM has assessed the monetary policy actions of the Federal Reserve in response to the current and anticipated economic environment across the U.S. amid the COVID-19 pandemic and the Fed's concern about inflation. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Adkins 60 City Home Price Index, and it provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Adkins Capital Management. Adkins Capital Management is a privately owned and independently operated company. Our exclusive focus is on residential real estate. Our company is not affiliated with any parties associated with the residential housing industry. Our mission is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published articles. For more information about my background, skills, and experience, please visit the Adkins Capital Management website. With this overview of ACM in mind, let me now turn your attention to our assessment of the JCHS report. The first section of our analysis pertains to housing policies. The general theme of this section is that the pandemic exacerbated inequities among homeowners. For the second quarter of 2021, the annual release of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University provided a wealth of information pertaining to the U.S. residential housing environment. The COVID-19 pandemic has had a dramatic impact on the U.S. economy and the state of the nation's housing. According to the Census Bureau's Household Pulse surveys, 46% of low-income homeowners in early 2021 reported having lost employment income since the start of the pandemic. Given the economic curtailment caused by the COVID-19 pandemic, the federal government instituted 3 programs with the primary goal of keeping people safely in their home. The CARES Act of March 2020 was the first major legislation during the pandemic to provide direct payments to many individuals and expanded benefits to unemployed workers to help with the basic costs of living, including housing. The CARES Act instituted a partial eviction moratorium from March of 2020 to late July of 2020, along with a foreclosure moratorium that was extended to June of 2021. The Consolidated Appropriations Act, enacted in December of 2020, followed up with additional relief that included $25 billion in rental assistance, $600 in direct stimulus payments, and extensions to both the expanded unemployment benefits and the CDC eviction moratorium. In September of 2020, the CDC instituted a nationwide eviction moratorium, which the Biden administration extended to June 30th, 2021. However, this moratorium was successfully challenged in the courts in May and is pending appeal. As of May 1st, 2021, 17 states still had eviction moratoriums in place. The American Rescue Plan of March 2021 delivered yet more aid, including $1,400 in direct payments to individuals, $300 per month in extra unemployment benefits, $10 billion in homeowner assistance, and another $25 billion in rental assistance. Household pulse surveys from the first quarter of 2021 indicate that nearly 40% of homeowners had lost income due to the pandemic, and 9% of homeowners were behind on their mortgage payments. Low-income homeowners were more apt to be in arrears on their mortgage loan. The share of homeowners making less than $25,000 that were behind on their mortgage payments increased from 20% in August of 2020 to 24% in the first quarter of 2021. 15% of homeowners with incomes of $25,000 and $49,999 were delinquent, and 11% of homeowners with incomes of $50,000 and $74,999 were delinquent. In contrast to low-income homeowners, just 5% of homeowners earning at least $75,000 were behind on their mortgages in early 2021. According to Black Knight, 7.1 million homeowners, which represents 14% of all mortgage holders, entered into forbearance during the pandemic. Of these, 4.8 million, or 68%, had exited the programs by March of 2021. However, some 2.3 million homeowners were still in active forbearance in early 2021, which for most homeowners will end by July of 2021. Lenders often resolve delinquencies by adding the accumulated debt to the mortgage and extending the loan term to cover the costs. While the pandemic brought havoc on many lower-income homeowners, record low mortgage loan interest rates fueled a mortgage loan refinancing boom in 2020 for many higher-income homeowners. The Mortgage Bankers Association reported that nearly $2.4 trillion in mortgage refinances took place in 2020, more than double the volume in the prior year and the highest annual dollar total since 2003. While purchase origination volumes also increased from $1.2 trillion to $1.4 trillion, the refinancing share of total mortgage loan volume jumped from 45.6% in 2019 to 61% in 2020. High-income borrowers benefited the most from refinancing last year. Recent research from Freddie Mac shows that borrowers in the top income quintile were 5 times more likely to refinance than those in the bottom income quintile. The disparity in refinancing rates between high and low income homeowners in 2020 and in the amount of savings each group realized is unusually wide and further evidence of how the pandemic has exacerbated inequalities. The second section of our JCHS analysis pertains to housing problems. The general theme of this section is that the housing industry is faced with a quagmire of multi-trillion-dollar issues. The aging U.S. housing stock is a cause for concern for the state of the nation's housing. The median age of the U.S. housing stock increased sharply from 34 years in 2007 to 41 years in 2019. A 2019 analysis by the Federal Reserve Bank of Philadelphia and PolicyMap found that 45% of homes built before 1940 were in need of repair, compared with 26% of homes built in 2000 or later. This study also estimated that more than a third of all occupied homes in 2017 had structural, plumbing, electrical, and heating problems, leaks, and/or pest infestations, and put the total cost of addressing these needs at $127 billion. It is likely that overall repair needs are even higher today, given that many homeowners had to put off these types of expenses during the COVID-19 pandemic. Climate change has also made improving the energy efficiency and resiliency of housing ever more urgent. Given that residential energy use accounts for a fifth of the nation's greenhouse gas emissions, retrofitting older homes with energy-efficient systems would help to reduce the nation's reliance on fossil fuels. Another unmet housing need is for more home modifications that enable older households to remain in place as they age. At last measure in 2011, however, only 3.5% of the U.S. housing stock provided three critical accessibility features: a no-step entry, single-floor living, and extra-wide doorways and halls that help households with reduced mobility to live safely and comfortably in their homes. ACM believes that this housing problem needs immediate federal policy attention. Overall, while it should be obvious that older housing generally needs more upkeep than newer housing, it also cannot be overstated that there is a critical need for substantial investments in the nation's housing stock to reduce the residential sector's contribution to greenhouse gas emissions, safeguard homes and residents against severe weather, preserve the existing supply of affordable housing, and prepare for a rapidly aging society. It cannot be overstated that the threat of climate change and natural disasters is a growing concern for homeowners. The number of major disasters hit a new high in 2020. There were 22 distinct billion-dollar disasters in 2020, up from the previous high of 16 in 2011 and 2017. The combined cost of last year's disasters was $95 billion, making it the fourth costliest year since the National Oceanic and Atmospheric Administration started tracking major disasters in the early 1980s. For homeowners alone, real spending on disaster repairs climbed from $8 billion in 2000 to $14 billion in 2010 and to $26 billion in 2019. The adjacent chart illustrates spending on homeowner disaster repairs since 2000. As severe weather becomes more common, it poses an ever-growing threat to homes across the country. The First Street Foundation estimated that 14.6 million properties were at substantial risk of flooding last year, some 5.9 million more than identified by the Federal Emergency Management Agency. By CoreLogic's count, 7.1 million single-family homes and 253,000 multifamily units were under threat from storm surges, with a total reconstruction cost of $2.65 trillion. In assessing vulnerabilities to 7 types of natural hazards, CoreLogic found that states most at risk were California, Kansas, Nebraska, Oklahoma, and Texas. The analysis also identified multi-state hotspots around the Mississippi River, the Gulf Coast, and the Atlantic Coast. Housing design flaws and deficient housing materials pose many problems for a significant amount of U.S. housing stock. Many homes do not have air conditioning, and rising temperatures are hazardous to people living in these types of homes, particularly older adults and young children. Smoke from wildfires is another serious hazard because it can infiltrate homes via poorly sealed windows, doors, and ventilation systems, degrading air quality and aggravating respiratory problems. In the case of flooding, the presence of mold can be dangerous to people with asthma and other acute conditions. Homes with crawl spaces are also susceptible to this problem, even if they are not located in a floodplain. The CDC estimates that 24 million housing units contain significant amounts of lead-based paint, a particularly toxic health threat to the young children living in 4 million of those homes. The need to quarantine during the pandemic increased the exposure of those children to this hazard, while also preventing lead testing and mitigation efforts. According to the Mesothelioma Center, asbestos in cement, floor tiles, insulation, walls, and pipes is a problem for homes built prior to 1980. As homes are updated and made more energy efficient, the disturbance and removal of old materials containing asbestos could cause the remodelers and homeowners to develop the cancer known as mesothelioma. ACM believes that this housing problem needs immediate federal policy attention. The third section of our JCHS analysis pertains to housing inventory. The general theme of this section is that policy regulations and building input costs are causing a multi-million shortfall in the level of needed housing units. The general theme of the U.S. housing market in 2020 is one of tight supply amid soaring house prices and high demand. There were 1.03 million existing homes on the market in February of 2021, down from an already low of 1.46 million a year earlier. This amounts to a 29% decline in just 1 year and a 37% drop in 2 years. Single-family homes accounted for only 870,000 of the existing units available, the lowest level in records dating back to 1982. Inventories of existing homes for sale fell from 3 months in December of 2019 to 1.9 months in December of 2020. The supply of single-family homes was even tighter, at just 1.8 months, marking the first dip below 2 months since record-keeping began in the early 1980s. As a rule of thumb, a balanced market has about 6 months of available inventory. New residential construction rebounded quickly in the summer of 2020. Housing starts climbed 6.9% last year to 1.38 million units, the highest output since 2006, when production reached 1.8 million units. Housing completions were up 2.5% to 1.29 million units, while permitting rose 6.1% to 1.47 million units. For the first time in 3 years, single-family construction drove the increase in production in 2020. Starts of single-family homes jumped to 991,000 units. This represents a substantial pickup from the previous 13 years, when starts consistently lagged below the 1 million mark. Multifamily housing construction dipped 3% last year to 389,100 units, but remained on par with the elevated pace maintained since 2014. Multifamily starts topped 350,000 units just once in the 24 years from 1990 through 2013, but then exceeded that level for the next 7 years. Freddie Mac estimates that the housing supply at the end of 2020 was 3.8 million units short of the level needed to match long-term demand. A continuing theme from the Adkins Capital Management 2021 Q1 Residential Housing Market Review is that restrictive land use regulations are among the most significant barriers to housing production. A 2018 survey of land use practices in nearly 2,800 communities found that 93% imposed minimum lot sizes in their jurisdictions. Some 40% of these communities set a 1-acre minimum, including 27% with 2-acre minimums. The median land value of a quarter-acre lot occupied by an existing single-family home was $163,500 in 2019, some 60% higher than in 2012. Among the nation's 100 largest markets, median land prices were higher on the West Coast, particularly San Jose at $1.2 million and San Francisco at $945,900. The cost and availability of labor is yet another issue for home builders. The average hourly wage in the construction industry increased by 2.8% in March of 2021 from a year earlier to $32.25 per hour. The National Association of Home Builders Wells Fargo Housing Market Index indicates that the top concerns for home builders in 2020 were the scarcity and cost of building materials, likely exacerbated by supply chain problems during the pandemic. As illustrated in the adjacent chart, the surge in softwood lumber prices is particularly alarming, up some 83% year over year in March 2021. A recent NAHB analysis found that the jump in lumber costs added about $36,000 to the average price of a new single-family home. The price of inputs to new residential construction overall rose by a substantial 14% year over year in March of 2021. The fourth section of our JCHS analysis pertains to housing sales. The general theme of this section is a tale of high sales, prices, and demand. In terms of housing sales, the general theme of the U.S. housing market in 2020 is one of soaring house prices amid high demand and tight supply. Total home sales were at their highest level since the peak of the housing boom in 2006. Sales of existing homes were up 20% year over year from September of 2020 through February of 2021. Sales of new single-family homes rebounded even earlier and faster, increasing by more than 30% on average from June through February. For 2020 as a whole, existing home sales rose 5.6% and new single-family home sales jumped 20.4%. Months of supply for existing homes, measuring how many homes are available at the current sales rate, also fell steadily from 3.9 months on average in 2019 to 3.1 months in 2020, and dipped below 2 months in late 2020 for the first time ever. Median time on the market also hit a record low in March at 18 days. Despite a sharp drop at the onset of the pandemic, home sales bounced back quickly in 2020. Several factors helped to buoy sales, starting with record low mortgage interest rates. The pandemic itself drove up demand for more private living space, particularly among the higher income households that were least affected by the economic downturn. The aging of the millennial generation also helped by lifting the number of households in their peak home buying years. As illustrated in the adjacent chart, sales of existing homes increased 5.6% for the year to 5.64 million units. Single-family home sales were especially strong, up 6.3% to 5.07 million units. For 2020 as a whole, sales of new single-family homes were up 20.4% to 822,000 units, the highest mark since 2006. The fifth section of our JCHS analysis pertains to housing ownership. The general theme of this section is that the housing rates and ratios illuminate the significant housing cost burden facing many Americans. According to the Housing Vacancy Survey, the national home ownership rate stood at 65.6% in the first quarter of 2021, a 0.3 percentage point increase from a year earlier. The number of homeowners rose by about 1.3 million over this period, consistent with average annual gains from 2016 to 2019. The National Association of Realtors reports that the median sales price of homes jumped 28% from $233,000 in December of 2016 to $299,000 in December of 2020. From December of 2019 to December of 2020 alone, the median sales price increased by 10%. Based on ACM's analysis, further research needs to be conducted in order to identify the home ownership rate by household income amount. By undertaking such an evaluation, the housing cost burden, which will be explained on the next page, can be more accurately assessed in order to gauge the state of the nation's housing. Home price gains continued to outrun income growth last year, lifting the national price-to-income ratio to 4.4, the highest level since 2006. 2 decades ago, the ratio was less than 3 times income in 2/3 of the 100 largest metros, and above 5 times income in only a handful of markets. In 2020, price-to-income ratios were under 3 in only 16 metros, and above 5 in 23 metros. The chart below illustrates the home price-to-income ratios since 2000. Nearly half of all renter households, approximately 20.4 million, and nearly a fifth of homeowner households, approximately 16.7 million, spent more than 30% of their incomes on housing in 2019. Of these 37.1 million households, 17.6 million spent more than 50% of their incomes on housing. According to the adjacent chart, more than 3/5 of renters and nearly half of homeowners earning less than $25,000 were severely cost burdened in 2019, along with 1 in 6 renters and 1 in 8 homeowners earning $25,000 to $49,999. In contrast, less than 2% of all households earning $50,000 or more had severe burdens. It's important to note that cost-burdened households pay more than 30% of income for housing, and that severely cost-burdened households pay more than 50%. Based on the analysis conducted by ACM, the adjacent chart information illustrates that too many lower-income households have made very imprudent home purchase decisions. Accordingly, prospective home buyers need to use the Adkins Residential Home Valuation Analyzer in order to make a prudent home purchase decision. Moving away from the ACM analysis of the JCHS report, and instead focusing on monetary policy, it is important to note that in view of the economic impact of the global COVID-19 pandemic on the U.S. economy, the Federal Reserve maintained the target range for the federal funds rate at 0% to 0.25%. The concern over inflation is a daily theme in the financial news media. However, the Federal Reserve Chairman has stated that inflation has increased notably, due mostly to temporary factors, and therefore the economy is a ways off from where it needs to be for the central bank to change policy. The Federal Reserve expects that it will be appropriate to maintain the current target range for the federal funds rate until inflation has risen to 2% and is on track to moderately exceed 2% for some time, and when labor market conditions have reached levels consistent with the committee's assessments of maximum employment. While it is logical to conclude that if the COVID-19 pandemic continues to curtail the U.S. economy, mortgage loan interest rates will continue to remain low, or even inch toward more all-time lows, in order to not impede housing market sales activity. However, the increased debt level that has been caused by the federal government's stimulus packages will likely drive Treasury yields higher, which in turn will drive mortgage loan interest rates upwards. Nevertheless, historically speaking, mortgage loan interest rates are still at very low levels. In accordance with the monetary policy actions of the Federal Reserve, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 3.25% and ended the quarter at 3.17%. In order to provide some context for these rates, it is important to note that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 2.67% on December 17, 2020, and the all-time high of 18.63% in October of 1981. Now that I have provided an overview of the events and trends that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary finance-based analytical methodology and cloud-based residential real estate analysis software application that you can use in order to provide an assessment of the price level of homes in your community. The Adkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Adkins Residential Home Valuation Analyzer can accurately assess the price level of homes in your city. From the first analytical perspective, the Adkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in your city by calculating the mortgage loan interest rate that justifies the price level of homes in your city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in your city. From the second analytical perspective, the Adkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in your city in order to justify the price level of homes in your city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in your city. By utilizing the Adkins Residential Home Valuation Analyzer, you can determine the level of underpricing or overpricing of homes in your community, as well as the magnitude of underpricing or overpricing of a specific home that you are considering to purchase. This in turn will help you make a prudent home purchase decision. For more information about our finance-based analytical methodology and the use of the Adkins Residential Home Valuation Analyzer, please review our finance-based analytical methodology report on the Adkins Capital Management website and watch the wealth of movie presentations that provide an overview of the Adkins Residential Home Valuation Analyzer. Moving away from the analysis of the JCHS report and the monetary policy actions of the Federal Reserve on the U.S. mortgage lending environment, and instead focusing on an assessment of the price level of homes across the country, it is important to note that for the second quarter of this year, 21 cities that make up the Adkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, Los Angeles, Honolulu, New York City, and Boston were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 3.17% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective home buyers to spend more than the respective justified percentage of household income amounts. In order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $116,854 and $252,985. In addition, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $313,738 and $522,688. Prospective home buyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of overpricing of homes in their community. On the other side of the spectrum, based upon the justified percentage of household income amount, 39 cities that make up the Adkins 60 City Home Price Index were classified as underpriced for the quarter. Detroit, Jackson, Baltimore, St. Louis, and Indianapolis were identified as the top 5 most underpriced cities in the index. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 3.17% to more than the respective justified mortgage loan interest rate amount for each city, which fell within the range of 10.75% and 19.7%. Or it would have to be deemed imprudent by prospective homebuyers to spend as much as the respective justified percentage of household income amount for each city in order to repay the cost of a mortgage loan. Given the recent events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. First, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the level of underpricing or overpricing of homes in their community. Second, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the largest amount of money they should spend in order to purchase a home. Third, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess the amount of money they would need to earn on an annual basis in order to be able to afford to purchase a specific home. Fourth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess total home ownership costs expressed as a percentage of household income. And fifth, prospective homebuyers should use the Adkins Residential Home Valuation Analyzer in order to assess how much a home would need to appreciate in value each year in order to offset the costs associated with owning the home. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Adkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, or to subscribe to use the Adkins Residential Home Valuation Analyzer, please visit the Adkins Capital Management website at residentialrealestateanalysis.com. This is Troy Adkins, saying thank you for taking the time to listen to this presentation.